Medical Properties Trust is a hospital REIT that is currently paying in excess of 9% current dividend yield. Look at the historical performance of this company from an income perspective. Had you invested $10,000 in January 1st, 2010, the stock would have paid you 8% that year, or $800. They kept their dividend the same for the next 3 years, but then starting in 2013, they raised it to $810, $840, $880, $910, $960, $1,000, $1,020, $1,080, $1,120, and then finally last year, $1,160, bringing you an 11.6% what we call growth yield. Best part of this stock, it is unbelievably cheap with a very high margin of safety. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. In this video, we're going to take a look at Medical Properties Trust. Now, I do want to tell you before I get started in the video, this company reports on the 23rd. They report earnings, and there's been a lot of controversy, a lot of short selling. They've had trouble with Steward, one of their biggest tenants, but they've reduced that risk greatly. And in this video, we also have a link to the article that we've posted on our website, which comprehensively covers the company. So what we're going to do in this video is go through Medical Property Trust by the numbers and look at some key numbers that I think you should be aware of. Now, your decision is whether you should invest before the earnings announcement or after is your choice to make. The risk is if it comes out with really great news, the stock could run and you could miss a really great opportunity or partially miss it. I think the stock is so cheap that you cannot possibly miss it here. So if you want to be conservative, wait till the earnings come out. If you want to be a little bit more aggressive, you can then invest now before the earnings come out on the advent that the management is going to make some really good announcements that might boost the stock, which is very possible because the stock is so cheap. We already had a very strong market boost of over an 8% gain just a few days ago in this company, as the risks are being mitigated. But we give you all of our thoughts on the comprehensive research in the article that we've posted on our website. In the video, I just want to highlight the numbers. Now, as a REIT, the critical number to look at is funds from operations. So as you're a subscriber to FastGraphs, you simply check the metric operating cash flow, which will automatically convert to funds from operations. Now, going back to 2010, which is coming out of the recession of 2008 and 9, the years after that, this company has grown at about we'll call it 5% a year. A little bit lumpy. There's some years where, it had negative growth and some years it had positive growth. Because it's a REIT, I want you to notice they pay out the majority of their funds from operations by law. And you can see that the market has normally put about a 12.5 multiple of FFO on the stock. It currently trades at a blended price to FFO of 7.19. So in other words, the black price line is significantly below the blue line. So any risks of Steward causing them to either cut their dividend or cause them financial problems going forward is already priced in the stock. Okay. And as they say, no guts, no glory. This is an extremely undervalued REIT based on the expectation for continuance. Now, I do want to put a caveat. After February 23rd, maybe a couple of days afterwards, if there's any changes in analyst estimates, they will begin to show up. But based on current analyst estimates, this stock would be extremely undervalued. Okay, you're looking at a stock that if you bought it today, in the next couple of years, assuming estimates come out as forecast, would generate a 27% plus annualized rate of return and throw off some really nice dividends. Now, we are not currently showing the dividends. That's pure capital appreciation. So if I go to the forecasting calculator and run this same type of calculation, you would get an opportunity to see an incredible gain at a 15 multiple. But if you was more conservative and looked at the normal multiple, you would see the potential for a 38% gain, of which, once again, you've got capital appreciation of 66.69%, and then a dividend, and that's without an annualized return of 31%. Let me clarify that because I did that very badly. Your stock would go up 67%, round numbers, from this point out to the end of 2024. That would represent an annualized rate of return or capital gain annualized of around 31.5. That's consistent with the 27 that I showed earlier. Add in the dividend, in that case, the prorated dividend of $2.17, and that gets your total return up to 83.71% for a total annualized rate of return of 38.44%. So this stock is extremely cheap, and I would argue that the risk associated with investing in this company, as through yesterday's close, it was yielding 8.95%. If I get a current quote from the Wall Street Journal based on it being down 3% today, this is pre-earnings announcement, you've got a dividend yield currently, if you bought it today, of over 9.24%, according to the Wall Street Journal. An incredible dividend yield, regardless of whether the stock has capital appreciation or not. A couple other things I want to look at here. I want to go through this company a little bit. If you look at it from a standpoint, I'm going to shorten the time frame here. Their dividend is, they're going to pay out the majority of their funds from operations. Their AFFO, or adjusted funds from operations, is also covering the current dividend. And we talk about dividend coverage extensively in the article that we've posted on our website, co-authored by myself and James Long, a young analyst who's doing some contributing analysis for us. And I want to give a shout out to James. But anyway, Medical Properties Trust, AFFO, also looks attractive. But let's look at the company through the lens of fiscal fitness out of fund graphs, okay? So free cash flow is covering the dividend. That's FFO, if you will. Share buybacks is a big thing. This is a REIT, and it's not, we call it share buybacks, but as you can see, Medical Property continuously issue shares because they're using that money to buy real estate. Okay, now that has an effect on their return on assets, which are, reasonably low at about 2%, but they're above industry standard, which is what this black line is. So, we really kind of like that. Sales growth, revenue growth as a result of issuing those shares and using the money to buy additional properties that pay additional rents and gives them additional income. And we talk about other sources of income in the research report that we did. Sales growth, you can see, has been very strong. So this company has performed very, very well as an income-producing REIT. You can see from a standpoint of income now, not capital gain, going back to the beginning of when this particular performance report was generated, the stock is extremely undervalued. I want to make that clear. So we're comparing an undervalued stock, or REIT, to an overvalued market. And even then, if you look at the performance, the company would have given you 2.5 times your money. It would have generated a capital appreciation of just under 2%. In other words, turned $10,000 into $12,900, but it would have equally paid out $12,000 in dividends versus $5,000 in the market. So it would have been an average of 7.27%. But again, I want to emphasize that is due to the fact that the stock is extremely undervalued. If I were valuing this at its expected normal PE a year out, the rate of return would jump up to 9.2%. And that's, market price plus dividend income. So I really think this is an extraordinary opportunity for investors to get a chance to invest in a company with a very high margin of safety, because short sellers have driven the price down, and short sellers are market manipulators. I don't put much credence in short sellers because they're not only short sellers, they're short-term oriented. I'm a fundamental value investor, and I just believe, as Warren Buffett said, price is what you pay, value is what you get. To be conservative, wait till after the earnings report and make sure we haven't missed anything. If you want to be more aggressive in case the earnings look really good, the earnings report is really good and management says the right things and the stock rallies, buy it before or split the difference. Buy some just before earnings and be prepared to add to it after the earnings report. Anyway, this has been Chuck Carnevale saying thanks for watching. I hope you enjoy this. This is kind of a new format where we're going to try to do a kind of by the numbers, video of various stocks. And today we covered the REIT, Medical Properties Trust, and then we're going to back that up with sound fundamental research. Now, I'm still going to be doing videos for research candidates, for companies that we have not thoroughly vetted and researched. But I think giving you a combination of both, opportunities for you to do research on your own, as well as being able to take advantage of the research that we've conducted ourselves, is going to give you kind of an overall balance to, your investing strategies. Thanks for watching. If you liked the video, ring the bell, give me a like, subscribe to the channel, And for goodness sake, subscribe to Fast Graphs. There's so many exciting things happening and coming up on Fast Graphs, including the launch of international data real soon, where we're going to go from somewhere around 12,000 stocks to something like 70 or 80,000 stocks for you to review. Anyway, thanks for watching. See you next time.